Hello. Today in this lecture we will learn about what is stress testing and how stress testing is used in banking and financial service companies. Stress testing is a popular risk management technique used in banks, NBFCs, pension funds, trading firm, asset management firm, and all kinds of financial service companies use stress testing for the purpose of risk management. So we would like to learn stress testing a bit in this particular lecture. So if you're someone who is looking into a career in risk management, quantitative finance, in audit, or in any areas of banking and finance, I think you will find this lecture useful. All right. So what is stress testing? Well, so it's primarily about how banks and trading firms and all these financial service companies can handle extreme situations, right? Negative situations, bad situations. And it's about assessing whether these companies will be able to survive those extreme scenarios or not, right? And the scenarios can come from a variety of areas within the banking and financial service organization. It can come from a capital point of view. It can come from liquidity and profitability point of view. We'll discuss about these scenarios in detail in this particular lecture. So which institutions use stress testing for risk management? Banks, all kinds of banks, retail banks, commercial banks, investment banks, including the new age tech firms like the fintechs, even they use stress testing. NBFC, non-banking financial corporations, such as the building societies, the auto loan NBFCs and so on. So these firms also have to do stress testing. Insurance firms as well, trading firms as well, all kinds of trading firms, they use stress testing. Asset management firms such as mutual funds, pension funds, these firms also do stress testing for risk management purposes. The fintechs and payment companies, even they have to do stress testing for risk management purpose. Many large corporations which are not necessarily financial service organizations, even they do stress testing. For example, oil companies such as British Petroleum or Shell, these companies also do stress testing, right? Not necessarily just in the oil and gas sector, but even in other sectors, especially in commodity heavy sectors, the large corporations also do stress testing. So what's the main purpose? I spoke a bit about that, but the main purpose is just about evaluating stability in an organization. In banks and financial service companies, what is absolutely most important is to know whether the organization is able to survive a bad economic environment, because bad economic environments can come anytime, and whether financial service organization can withstand. We have seen in 2007 and 2008 financial crisis, many banks simply could not survive the financial crisis. Many banks such as Lehman Brothers, but also many banks in Europe went bankrupt. Recently we've seen some banks also going bankrupt and shutting down. Credit Suisse, for example. Credit Suisse was more than 100 years bank. It doesn't exist anymore. The Silicon Valley Bank, 2 years back, it had to file for bankruptcy. So it's therefore very important that financial service organizations do stress testing on a regular basis to ensure that they have enough money to survive bad economic environments, right? It's also used for capital planning, right? How do you ensure where to put your capital? Do you have enough liquid assets to handle situations where you need money quickly, right? Regulators around the globe want financial service organizations to do stress testing. So this is something that is mandatory for many financial service companies, especially the banks, where people like us, we put our money and we trust the banks that they make good decisions and not take bad decisions and because the normal people will then get impacted, right? So it's mandatory for many banks. It may not be mandatory for all the financial service organizations, such as for, let's say, the newest fintech firms. Not all of them are required to do stress testing. Many trading and asset management firms, they are also not required to do stress testing, and that's not mandatory by the regulators in many countries. However, in many different jurisdictions, even the trading firms and asset management firms have to do stress testing. So it's also used for regulatory reporting. There are various types of stress tests. Okay, so we will learn quite a bit about the different types in this particular lecture. The primarily 3 types. There are many more, by the way. Okay, but primarily 3. Sensitivity analysis, that's one way of doing stress testing. Scenario analysis, a different way of doing stress testing. And the third one, which is known as the reverse stress testing, which is also a type of stress testing that banks perform. So what are these types? Okay, so let's learn a bit about what is sensitivity analysis. So this is a type of analysis where the banks, they see the impact of an adverse change in a single factor, and the single factor could be any macroeconomic indicator. It could be interest rate, it could be inflation, or it could be just one event, right? And what kind of impact is there or expected to be there in the bank's capital position or balance sheet or liquidity positions and so on, if that really happens. One example could be, there is, let's say, a 200 basis point rise in the interest rates. How is that going to impact the default rate in the banking book side of the bank, right? That's one way of doing this analysis, right? Just assessing the impact of an increase in the interest rate on the default rate, right? Because if there are more defaults, there will be more losses or expected losses. There will be more provisions to be taken, and there will be also quite a bit of capital charges, right? So that something is assessed in sensitivity analysis. Remember that is just one factor that is taken. Scenario analysis, on the other hand, is different from sensitivity analysis in the way that in scenario analysis we take more than one factor. There are multiple macroeconomic factors taken into account that if together there is an impact because of the adverse changes in different macroeconomic variables, how is the bank's balance sheet or capital position, liquidity position, all that will get impacted. One example could be in a more recessionary scenario, if the GDP falls by, let's say, 3% and unemployment rises by 10% and house prices drop by 20%, how is that going to impact the bank, right? That's going to have really a bad impact, right? A very adverse impact on the bank's balance sheet. First of all, okay, the interest payment will be less. Okay, so that's one. Okay, the profitability will get impacted, but the non-performing assets are likely to be higher simply because, okay, we see more and more people not having jobs, so they won't be able to pay their mortgages and so on. House prices going down, so even if the people are willing to sell the house prices, there is not enough liquidity in the market, so it will result in, let's say, undervaluations of the assets or the collateral, right? So in a number of ways the banks will get impacted, and that will affect the banks very badly, right? So all those analysis is done as part of scenario analysis. There can be multiple such scenarios with combination of various macroeconomic factors taken to ensure that the bank is prudent, bank is not insolvent in that kind of scenarios, right? So that's sensitive scenario analysis, and it's very quantitative, by the way. So when you forecast something on unemployment and housing prices and so on, so for these things are done using quantitative modeling. Okay, and hence quant finance professionals, many of them work in stress testing. Then reverse stress testing is very different from the other two. Okay, reverse stress testing is one way of stress testing where you start from the final outcome. The final outcome in the previous two cases was that, okay, something bad will happen. Okay, you start with that and then walk in a reverse way or a backward way to identify in which conditions this final outcome will happen. The final outcome could be, let's say insolvency of the bank. The bank becomes insolvent. So under what conditions or in which situations a given bank will likely to be insolvent, right? You do that more in a backward fashions, right? It could be combinations of different, losses, higher provisions, macroeconomic events, geopolitical events such as war and so on, or even climate events, right? So there can be many ways in which a bank could go bankrupt, but you do this analysis starting from this hypothesis that, okay, let's assume that the bank goes bankrupt. What could be the reasons? And you do this in a more backward fashion, right? And you simulate the scenarios through your historical data and so on. So you do a bit of a Monte Carlo simulation here. Okay. For different types of stress test, you use different types of matrices, right? Commonly used matrices are, in the capital side, you use the capital adequacy ratio, right? You have the capital adequacy ratio for varieties of, varieties of activities. So you use that. The CET1 ratio, which is almost always reported by the banks in their quarterly calls, right? You see the CET1 ratio is mentioned almost every time, simply because the investors and even the depositors in the bank, they want to know what is the CET1 ratio, because that gives an indication as to the strength of the bank in an adverse scenario, right? Liquidity coverage ratio or the net stability funding ratio, these matrices are used in liquidity stress testing. Non-performing loans used in credit risk assessments. Okay, stress testing on credit risk. Stress testing can also be used not just in banking activities like lending activities, but also in trading and asset management activities. Many people do not know that stress testing is also done in trading and asset management departments within a bank, but also the specialized trading firms, which are not necessarily using public money, but they are proprietary trading firms. They use their own money. Even their companies do stress testing. Asset management funds such as pension fund, mutual funds, even they do stress testing. Oftentimes the discussion is mostly about the banks, simply because stress testing, the chunk of the stress testing is done in the banks and less in trading and asset management firms. Also, if you see the number of people who work in stress testing in banks is much higher compared to in trading and asset management firm, and hence it's less popular. But note that it's definitely an important activities for trading firms, right? And what's the objective here? The objective is to know that whether the trading firms would perform under extreme market conditions, right? Extreme market conditions could be, any event, right? A war, interest rate rise, rise in the inflation, and several factors could play a role, even climatic events and so on, right? So the vulnerability could come from a varieties of conditions, right? Mostly market risk, because trading is primarily affected by market risk. However, there are other kinds of risk involved also. For example, credit risk as well. Even in trading firms, you have a counterparty, the probability of or the chances of counterparty defaulting on a given commitment. So that could also happen. So that can also happen in financial markets, right? There can also be risk coming from liquidity or not having enough liquidity in the market. So so in trading firm, the stress testing is about, okay, let's simulate situations or conditions under which trading firms will not be able to survive. And all the three types of stress testing that we learned in the last few slides can also be done in trading and asset management firms. So what are the things that are done in trading firms? First of all, to evaluate whether there will be a P&L impact, okay, the profit and loss impact under extreme market moves. We have seen that happening during COVID times, during financial crisis, during the sovereign crisis in Europe, but also more recently during Ukraine war and so on. So there can be several situations where you have a large P&L impact because of extreme market moves, right? Even more recently, right, 2 months back, we saw a big move, right, in the markets because of the tariffs, right? And then risk could also come from heavy concentration, right? Concentration in a given asset, right? For example, concentration in large tech firms like the Magnificent Seven, for example. Many firms have done a stress testing that what if something really bad happens? What if there is the AI hype bursts, right? We have seen that happening in 2001 when the dot-com boom burst, and many firms, many asset management and trading firms lost a hell lot of money simply because they were heavily exposed to internet companies back then, right? So that could also be a potential source of risk, right? So it's about then testing the robustness of different trading strategies and different limits and whether there are stop losses in place and at what level and so on, right? Assessing the impact on margin requirements and liquidity calls. It could also be something to test, but there are also some other things which are required to be done because regulators want large trading firms to do some reporting activities. There are expectations, for example, on the Basel from the Basel Accord, but also from the MiFID and on all of that. Some of the large trading firms have to do some reporting activities, and they therefore have to do stress testing. Well, the risk factors could come, especially in trading and asset management. Risk factors could come from varieties of things. I've said about interest rate movements, but it can also be because of extreme movements in equity. For just one tweet of Donald Trump, there can be a 10% rise or 10% crash, right? And that's something we have seen in the last 3 months, right? Credit spread widening. We have seen that happening during the sovereign crisis. Also more recently we have seen that happening for the US bonds. You see the spread increasing, and for large companies, for example, for Credit Suisse, the credit spread increased quite a bit. So that could happen. Commodity price and the shocks because of that. We have seen that during Ukraine. Energy and oil and all of that actually went through quite a bit of stress, right? And because of that, many companies had to face. So these factors could bring in issues or losses to these companies, and hence the stress testing would be around assessing the extreme movement on these particular factors. It could be also foreign exchange, liquidity squeezes and counterparty defaulting, which could happen very rarely, but sometimes that can happen as well. In trading firms, these are some of the tools that's used, such as using value at risk and conditional value at risk, or stressed bars is also used. Now, if you have ever worked in market risk, these terminologies are probably familiar with you, but if you have never worked, don't worry about. These are some of the models used to assess for example, expected losses, and there are different ways to assess this, and stressed value at risk is one of the way to assess that in stress scenario what could be my potential losses, right? And there can be also scenario generation models using Monte Carlo simulations. EAD models are also used in trading risk. Liquidity stress testing models also used in trading risk assessment. In the asset management side, it's often less talked about, but more recently, I came across a wonderful stress test working paper from the Sovereign Wealth Fund of Norway, which is, I think, one of the biggest wealth fund. If I'm not wrong, it's perhaps the biggest wealth fund in the world, and they do annual stress test on their positions. It's a very interesting paper. They're probably required to do because it's sovereign wealth fund. It's managed by the government, and the government has to produce these reports for the public. But not every fund house has to do this, right? But I've also seen stress test reports coming from many funds in India, but in the US as well. Okay, but the guidelines as to how to do stress testing in wealth funds, asset management funds, are not that clear compared to the guidelines used in banks and insurance firms. Okay, so there it's about assessing the again the extreme movements of various risk factors such as inflation or yield curve changing its shape and so on. So that these some of the things that the asset management firms look at while doing the stress testing activities. And all the three types that we talked about in the past, all the three types of stress testing can be done on asset management side as well. So what are the regulatory requirements in stress testing? Well, as I've said already, regulatory requirements are very strict in some jurisdictions. In the US, stress testing is extremely important. After the 2007 and 8 financial crisis, the US Fed introduced very stringent stress testing for large banking and financial companies. They call it bank holding companies. I think the threshold is that anyone managing an asset above 100 billion US dollar has to do proper, very stringent, strict stress testing activities. CCAR and the DFAST are some of the well-known stress testing programs in the US, mandated by the Federal Reserve there. In the European Union, you have several such programs as well. So you have the scenario assessment on various economic indicators, and these indicators are provided, and the scenarios also provided by the EBA, which is the regulators in collaboration with ECB, and to the banks in the European Union. In the UK, they also have annual cyclical scenario stress test. In the European, it's once in 2 years, but in UK, it's like every year you have to do it. Okay, stress testing uses a number of quant models. I've said it before that quant finance professionals work in stress testing. Many of them work in stress testing, especially in the US, but also in other locations as well. Stress testing can take place in varieties of areas within a bank, an insurance firm, or a trading firm. In the bank, you have stress testing happening on credit risk side, where people use the PD, LGD, EAD models. But it's not just on capital, but also on provisioning side. That means the IFRS 9 part also is covered there. And the Monte Carlo simulation models, Markov chain models are used for different scenario projections, and the value at risk models are used in the market risk side. Time series is very popular technique used in the field of stress testing, because time series is very perhaps the most popular modeling technique used for forecasting, especially forecasting of time macroeconomic data such as inflation and interest rate and GDP growth and so on, right? Derivative pricing models are also used in varieties of stress testing activities. Just to conclude, stress testing is an integral part of risk management across various financial service companies, banks, insurance firms, asset management firms, trading firms, fintechs. And if you really want to work in stress testing, you really need to learn risk management, statistical modeling, quantitative modeling, varieties of models used in various risk management activities, whether it's the PD, LGD, EAD model in credit, or value at risk in market, or the liquidity risk models, interest rate risk models, and so on. Right? If you're aiming to work in risk management and you want to learn these techniques, then do reach out to us. We do have a course on quantitative finance and risk modeling. It's a very comprehensive course, and it's covers pretty much everything that you are supposed to know as a quantitative finance expert. You can work at banks and hedge funds and consulting firms, big four consulting firms, and variety of other financial service organization as a quant, as a risk modeler, as a risk management expert. So do reach out to us for details. Thank you. Thanks for watching, and let me know if you have questions in the comment section. Thanks, guys.